And I tried to explain what was happening. And I made the analogy straight back to Bitcoin. If you wonder why Bitcoin is up 120% since the ETF launched, it's that ETFs and companies have been buying 5 times the supply of Bitcoin. And Econ 101 says more demand than supply equals higher prices. And what happened in ETH is around May 15th, we turned a switch, right? We had done $2.5 billion in inflows and no corporate purchases from the launch of ETH ETFs in July of 2024 until May 2025. There was no supply and demand were basically even with the amount of being produced. But since then, ETH ETFs have been on a tear. They pulled down $5 billion in inflows. Tom Lee is out there buying ETH. There are other ETH treasury companies. By our estimate, demand from ETFs and corporations have exceeded new ETH supply by 32 to 1 since May 15th. 32 to 1, more than Bitcoin.
In his opening remarks, Matt Hougan makes a compelling argument for the cryptocurrency market's anticipated rapid expansion, highlighting Ethereum ETFs and Bitcoin in particular. He highlights that enhanced market infrastructure, more transparent regulations, and rising confidence among conventional investors are all driving a significant wave of institutional adoption that is only just getting started. The next cycle may be larger and more revolutionary than any previous one. If you're intrigued by bold predictions and deep financial insights, make sure to like this video, subscribe to the channel, and turn on notifications for more engaging content. Thank you for your support and enjoy the video.
And Ethereum, and then everything else is probably going to be a lot smaller than what we've seen on the Bitcoin side of things.
Yeah, I agree with that. I'd also add, I'm really optimistic on Bitcoin and Ethereum inflows over the next year. So I think they're going to pull down a lot of assets. I think some of these small funds, smaller assets will do well. I wouldn't be shocked if you ended year one with $1 billion in a Solana ETF or $1 billion in it. That's within the realm of possibility. For what it's worth, that would make it like, I don't know, a top 50 ETF launch of all time, right? Crypto is so spoiled by these Bitcoin ETF launches. Most ETF providers are like thrilled if they get to 100 million in year one. That is a gangbuster success. So I think they'll be successful from that perspective, but crypto Twitter will probably be like, where's my $36 billion? And I tried to explain what was happening. And I made the analogy straight back to Bitcoin. If you wonder why Bitcoin is up 120% since the ETF launched, it's that ETFs and companies have been buying 5 times the supply of Bitcoin. And Econ 101 says more demand than supply equals higher prices. And what happened in ETH is around May 15th, we turned a switch, right? We had done $2.5 billion in inflows and no corporate purchases from the launch of ETH ETFs in July of 2024 until May 2025. There was no supply and demand were basically even with the amount of being produced. But since then, ETH ETFs have been on a tear. They pulled down $5 billion in inflows. Tom Lee is out there buying ETH. There are other ETH treasury companies. By our estimate, demand from ETFs and corporations have exceeded new ETH supply by 32 to 1 since May 15th. 32 to 1, more than Bitcoin. And people get all tied up about the valuation case for ETH. Is it cash flow driven? Is it store of value? Whatever. Any asset, if you have 32 times the demand than there is supply, the price is going to go up. And that happened. And I'm bullish for ETH because I think it's going to keep happening. I think ETF flows are going to accelerate. I think ETH treasury companies are going to keep buying. And you can try to be smart about it and do your DCF models, or you can see that demand is more than supply and you buy it and hold it. And I'm a simple guy. So that was the point I was making there. Just gonna add one more thing. I think the other thing with ETH is it stumbled into its narrative. Like if you think about ETH for the last 2 years, it was ultrasound money, it was digital oil, it was all these things. The community couldn't agree. And in the last 2 months, it's the chain for stablecoins and tokenization. And that sells to TradFi. They want exposure to stablecoins and tokenization. They don't care about value. They want exposure to that growth. And ETH has become that, and it's simplified the narrative. And I think that will carry it for, at least another year. I think that's going to be the story on ETH. But James, don't you think like as tokenized treasury funds go from a few $1 billion to tens, 20s, $50 billion, isn't Vanguard going to have to pay attention to that? And then they're going to be building funds on Ethereum. How are they telling their investors you can't have access to Ethereum if they're building funds on it? I'm really confident that they will be in the next 3 to 5 years. That's the direction the industry is moving in. So I think they're in a bind and they'll have to unwind it, and eventually they will. And I do think it's something that's happening. I think it's happening in the equity market, where you see the rise of these treasury companies and IPOs doing very well. I think there's like an altcoin cycle within equity crypto. And then I think it's happening in the crypto market. So a few people will raise that, but mostly it's just diversifying your exposure, broadening your exposure, gaining exposure to everything that crypto can offer. I agree that flows are going to accelerate for all the reasons that James said. These national account platforms are just now unlocking. For what it's worth, the due diligence they do is absolutely extraordinary. The most recent package we filled out was 650 pages long and involved multiple on-site visits from their teams. They really do this at a serious level. That's why it takes a long time. The other fact I would add, sad fact for me, but a fun fact for you, is the average Bitwise client allocates after 8 meetings. And if they started doing quarterly meetings when the Bitcoin ETF launched, they finished that run at the end of this year and start allocating in 2026. These people just move slower than crypto retail is used to. And so I think we'll set a new record for flows this year. I think we'll set a new record for flows next year, and so on. On the 4-year cycle, I bet 2026 is an up year. My thesis is that the factors that have driven the 4-year cycle, there are really 3 that people point to. One is the Bitcoin halving, one is interest rates, and one is blowups. Some combination of these things, interest rates and macro conditions. But the halving is half as important every 4 years, just statistically. Interest rates are as liable to go down as they are to go up. They went up aggressively in 2022 and up in 2018. And I think the risk of blowups is dramatically lower now that we have ETFs and regulation. So I think a lot of those negative forces have been tamped down. And at the same time, we have these flows in institutional purchases. So my money says 2026 is a pretty good year. Could be volatile. There could be pullbacks, of course. But I think we're going to go up in 2026 and break the 4-year cycle.
Meanwhile, funds are continuously moving into cryptocurrency through corporate investments and exchange-traded funds. Hougan thinks 2026 will be a great year for growth, perhaps even surpassing previous bull market tendencies, even though some price fluctuations are still anticipated. He also emphasizes the role that institutional investors play in market stabilization. For instance, advisors may sell some cryptocurrency when prices are high and purchase more when they are low if it accounts for between 5 and 10% of a portfolio. This type of rebalancing reduces the likelihood of large crashes like the 80% reductions we've previously witnessed and softens large dips. Please take a moment to like this video, subscribe to the channel, and enable post notifications for future Bitcoin, macroeconomic, and digital asset content before we go any further. Now, let's get into his powerful predictions.
Likely be bigger than even the Ethereum products are today, which are over $10 billion.
Wow.
Yeah, I agree with that. I think they're going to be the second biggest category. If you think most of the flows into ETFs are from TradFi investors, which over time will be true, I think a lot of them are just going to, buy the index the same way they do in stocks and bonds. So I think they'll be, I think they'll be very significant. And I think they'll be, after Bitcoin, the second biggest category in crypto. That's why we're so excited to bring them to market. I think the average opinion of Solana is better than it is for XRP across crypto investors. But that's not who buys the ETF on day one.
Exactly.
It's the passion, right? And so I went to an XRP conference in Vegas on a Saturday. There were 1,200 people in the room. Every seat was taken. That's crazy. Try to get that in a TradFi conference. No one's going on a Saturday. Mm-hmm. There is an army of people who are really passionate about XRP. And I think it would do exceptionally well out of the gate. It doesn't matter, again, that 90% of people hate it. What matters is 10% of people love it. That's what drives the flows on those initial days. And I think it would do well. If Solana is ripping, I think Solana is facing somewhat of a narrative transition that it's going through. And so depending on when it launched and where it is in that transition, I think that would matter a lot. If Solana is ripping, it would do well. But my base case out of the gate would be XRP, at least for the first few months. We've been in the market since 2017 at Bitwise, and I would say for the first 6 years, it was maybe 1%. And then for another year, it was 2.5%. And now I'm seeing a lot more 4 and 5%. We see sort of the wins come in from advisors, and I would say the wins today were in the range of 2.5 to 5% and more biased toward the 5%. And we see national account platforms talking up to 10%. For what it's worth, it makes sense because the volatility of crypto has come down substantially, right? And the risk in this market has come down, the regulatory risk, the custody risk, the trading risk, the legislative risk, that's reflected in lower vol. As vol comes down, allocations go up. And so I think this is just a rational part. I think we're going to end up in the 5 to 10% range for a lot of portfolios.
This is like my final big question for you guys.
James, you go first.
You want me to go first? I can do that. So I guess as far as the accelerating part, like the big thing, the big people that use ETFs mostly are advisors like that. Those are probably the number one use case. Obviously, hedge funds use it. Individual and retail use them a lot too. But for the most part, it's advisors and brokers and wealth management platforms, and they control tens of trillions of dollars in the U.S. alone, multiples of that globally, and they're pretty early as far as putting this in client portfolios. I mean, the people who are buying this, the early days are, the independent advisors, the people who went out on their own and have some sort of different back office and compliance rules, and they were able to buy this immediately. But for the most part, if you look at the UBSs of the world, the JP Morgans, you name it, they have usually a 3+ year due diligence process before they allow these things to be bought by the people using their platform. So you need to have a certain level of assets, certain level of liquidity. They want to watch your track record. Now that has been sped up for these assets specifically because, it's a single asset and you can just study the history of the asset for the most part. Also, there's a lot of demand from people saying, why can't I buy this for my clients? But for the most part, when an ETF is launched, it's no one can buy it, right? Not until we give it an okay. At these big platforms. And then there's some level in the middle where I refer to as a yellow light. So you go red light to yellow light, where it's you need a certain level of assets, or the client has to specifically request it from you to put in their portfolio. That's solicited versus unsolicited. But the green light on it, where you're you can just recommend it for a client portfolio, we're talking about 1%, 2%, 3%, what have you. For the most part, all these platforms, there's very few that are at that level. So once we get to that level, and as this whole space matures more and more, I think we could accelerate, honestly, as far as I'm concerned, with demand for these types of products. And I forget the first part of your question.
For your cycle, is it still intact?
Oh, yeah. So I think I'm somebody that thinks it will be intact, but it's going to be muted. I mean, if you look at it, I think those loops are kind of getting smaller. If you think about it like a roller coaster that's going down, I just think the amplitude isn't going to be as much. I don't know if we'll see an 80% pullback. Could we see 50? Maybe something along those lines. I don't know. I won't pretend to be a fortune teller, but I just think as these institutions come in, more stable money, stable backing, forced buyers in a way with these treasury companies and different things. I think the amplitude of those cycles is going to go down, and it won't be as strict on the money where everything collapses in November or December of whatever year is coming up. So yeah, I don't think it's completely done, just because human nature, liquidity cycles, you name it. But I just think it's getting more and more mature. And these people we're talking about, advisors, institutions, if they're going for a 3, 4, 5% allocation, if all of a sudden it jumps up to 10% of their portfolio and they're not ready to do that, they're going to sell as it goes up.
According to Matt Hougan, crypto ETFs, especially those that go beyond Bitcoin, are about to enter a significant new phase. With more conventional finance investors joining the market, he anticipates Ethereum ETFs will overtake all other cryptocurrency investment product categories as the second largest category. He points out that a lot of investors will just buy the index, as they do with stocks and bonds, which will result in consistent inflows. Hougan also emphasizes the strong backing for specific altcoins, such as Solana and XRP. Even while XRP may not be well liked by the whole cryptocurrency community, he saw firsthand at a crowded XRP conference that it has a large and devoted following. He explains that significant early ETF demand might be driven by that kind of devoted following, independent of general opinion. He then presents some important data, such as the growing proportion of cryptocurrency in investor portfolios. Only 1% of advisors invested in cryptocurrency a few years ago. These days, 2% to 5% allocations are typical, and some platforms are getting ready for 10% exposure. This development is mostly attributable to decreased volatility and increased confidence in the cryptocurrency ecosystem. Regulation, custody, and trading risks have all drastically decreased. Hougan continues to view the conventional 4-year cycle as mostly intact, but with a modification in terms of market cycles. It's conceivable that previous cycles' severe highs and lows will subside. We may witness softer 50% corrections rather than dramatic 80% crashes. The inflow of institutional capital has a stabilizing impact. Advisors will reduce a portfolio's growth if cryptocurrency grows too quickly and rebalance it by purchasing more if it falls too much. As a result, there are fewer fluctuations in the market over time. Please take a moment to like this video, subscribe to the channel, and enable post notifications for future Bitcoin, macroeconomic, and digital asset content. And as always, happy investing.